Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're an active investor, passive investor in multifamily, you're in the right spot. Because every single week on the Gray Report, we're breaking down all the latest news, research, article, data, and opinions, all centered around the multifamily industry, commercial real estate, but also the macro economy in general. So strap in. We've got a lot of really interesting pieces. We're going to be talking about NMHC, which is in Vegas this last week. I was there with the Gray Capital team, giving a little bit of a breakdown. We're getting into the jargon bin again. It's our new segment where we're breaking down multifamily investing terms in three layers from, again, novice, intermediate, and industry veteran. We're also going to be talking about, again, just some sentiment in the multifamily industry. I'm going to try to arm you with some really actionable insights so you can chart a really good course for 2026 and beyond. All right, Griffin Haddad is with me in the seat on the Gray Report. Once again, let's get into it. Welcome back to the Gray Report, joined once again by co-host of the Gray Report, Griffin Haddad. How's it going?
The crowd goes crazy.
I know.
It's going well. We are back in the podcast studio after what is really 2 weeks of a hiatus. You were out in Las Vegas at NMHC. We had a really a good old college try, maybe a failed attempt to fly at producing our own episode.
Yeah, a little technical difficulty. I think Griffin and I recorded a great episode.
We were in the podcast studio and we were recording, but we were down on producer Will. So great job security for Will. And in that 2 week hiatus, we also published our 300th episode or 300th issue of the Gray Report newsletter, which is pretty outstanding. In that 300th volume, we also introduced the first episode of the Jargon Bin, which I thought was somewhat ironic and a coincidental timing.
It was fascinating. Again, 300 emails for the newsletter, which again, there's a lot of newsletters out there. We've been consistent every single Thursday at 8:30 Eastern. Really back, you have to go all the way back to 2020 when we started. And it first originated when we were looking at the content that was out there in the multifamily industry. It was all mostly a little bit of an echo chamber and self-serving. It was all, I'm a syndicator, you're a syndicator, let's talk about our syndications. And I was just starving for a better source of market information, data, research, analysis. I was having to go around to all the different individual websites, and I felt like there wasn't really good aggregation of those reports. And so I said, hey, we've got to compile all these reports anyway for our own use at Gray Capital. Why don't we just do it on a regular basis, on a weekly basis, and let's make a list of all the new research reports that are released and any article related to multifamily that we should read, we want to read, share it with our investors in the broader industry, and let's just start sending it out once a week. Started doing that, and then a month or so later, we were like, well, why don't we just talk about it on a podcast? And 300 editions later, we're still doing it. Now the podcast, there's only been a handful of episodes or weeks that we've missed on the Gray Report also. So this was a little bit of a unique hiatus, but it hasn't been as consistent as the newsletter, which is in Griffin's producing the newsletter, writing it, putting it together, and it's awesome.
If you're looking for reliable insights, graycapitalllc.com/newsletter, subscribe.
Exactly.
And we'll get you those weekly insights without failure each and every week.
Yeah. No, we get a lot of comments. When I was out at NMHC this year, a lot of positive feedback for the podcast, but also the newsletter.
That was a wonderful thing. There were some, I got another message from Katrina that said she ran into some folks that just mentioned how not reliant they were on the newsletter, but how much they appreciated it each week and that they looked forward to receiving it in their inbox. And, you put it together each week and you send it out, kind of unknowing who's opening and who's actually reading and who's using it. But to get somewhat of words of affirmation of a job well done and the desire for us to continue, being consistent with it it goes a long way. So if you like the newsletter, let us know. And if you don't, also let us know. We're going to keep doing it anyways.
Yeah. Well, anyway, we've got a great episode today. There's a lot to unpack, and some of it's going to get to this episode. Some of it we're going to have to push out the next episode because we had a Fed meeting. We've got a new Fed nominee. We've had, sentiment reports coming out. technically we're in like a mini government shutdown. I don't know if the government's been reopened, but there's new data that's now going to be delayed. We've had an executive order related to single family homes and institutional investors, which we talked about just before that executive order, but that executive order has been in place. So there's been all kinds of news, all kinds of shifting in the market. Has it changed the trajectory of multifamily? That not really in terms of the fundamentals. The one thing that is different maybe today compared to when we were talking about when we last got together a couple of weeks ago is there's been a major shift in metals and commodities, but even then there's a big run up in gold and silver. Gold breached $5,000 an ounce. Silver crossed $100 an ounce. Those have corrected since then. They've come back. I think silver's down to mid 70s. Gold is I think closer to $5,000 an ounce. But it's reignited this discussion of the dollar itself, the strength of the dollar, the trajectory of the dollar, and also real assets. And that's where multifamily comes in. Because real multifamily, like gold, like silver, is a real asset. It's a tangible asset, has some scarcity, and the dynamics of when investors are looking to allocate to real assets, like whether it's gold, silver, or real estate, combined, also related to the reality that the value of the dollar is declining relative to other currencies, and there's maybe not serious conversations, but conversations about losing the dominance of the U.S. dollar, and as the dollar devalues, those assets that are denominated in dollars appear cheaper to international investors, and that dynamic of international money potentially flowing back into U.S. commercial real estate is really interesting. At the same time, there's a flight from our bonds, so it's kind of cutting either way. But so much to unpack, so much to talk about today, and we're going to get to most of it, probably not all of it. But I don't know. Where do you want to start, Griffin?
There's got to be some folks, some listeners, some viewers waiting anxiously for episode 2 of the Jargon Bin. So I'd like to get started with the Multifamily Jargon Bin, where each week Spencer and I are diving into a commercial real estate buzzword, vocabulary word, terminology, or phrase. We're doing it at 3 distinct levels of basic understanding, an intermediate level of understanding, and an industry veteran level of understanding. And this week, drum roll please, from the Multifamily Jargon Bin, we are breaking down the limited partner and general partner vocabulary word, and or LP and GP.
Yeah. There are two terms we talk about all the time, get thrown around. And like all of these phrases and jargon and terminology, you get so comfortable with it. And then all of a sudden you're having a conversation with someone. They're like, I don't really know what you're talking about. Or I sort of understand what you mean. But what does that actually mean? Like,
Correct.
LP, people probably think of as an investor, and GP is kind of the group's running the deals, raising the money. But like, what are those relationships?
And these two, phrases, limited partner, LP, and general partner, GP, they're very easy to, not Freudian slip, but to interchange and maybe not know that you're doing it in conversation. And it really does matter because they are very different, the LP and the GP, or the limited partner and the general partner. So let's go ahead and let's just get started as the basic introduction to a limited partner or an LP. What does that mean to you on a very base level of understanding?
Yeah, really basic. No, not history right behind the terms, but again, almost like 5th grade level of explanation. A limited partner is the group, the person that puts money into the deal, and the general partner or the GP is the person that runs the deal, that typically raises the money and makes the decisions for the deal itself. And that could be real estate. It could be private equity. Obviously, our context, we're typically talking about real estate.
And then just the same level of understanding, who qualifies or who can be an LP? And then kind of on the other side of the coin, what does it mean for somebody to step into a GP role? And how do you qualify as a GP? If I wanted to be, I'm listening to the Gray Report and I wanted to be an LP tomorrow, how would I go about doing that versus what are the barriers to entry to them becoming a general partner or a GP?
Yeah. Well, the good news is just about everybody can be an LP. not an LP in every type of deal or syndication. Many syndications or investment opportunities are limited to accredited investors or some other type of limitation of having to be registered in a certain way to participate. The definition of accredited investor is you're an individual that's been making $200,000 a year for the last several years, or married, making $300,000 a year, or you have a net worth of $1 million or more. But not every syndication requires you to be accredited. So any individual or any LLC or any type of entity can be a limited partner or an investor. Now, to get into the GP, and this is what this is where the conversation get a little bit muddy. I mean, from a pure standpoint, a GP is typically, an individual or a company, again, that is putting the deal together, that manages and controls the business itself. It also relates to economics and control. And so really when we're talking about LP and GP, we're defining how the economics flows and who has control. And every single partnership or structure can be structured slightly differently, but generally, the LPs are going to put the majority of the capital into an investment, and they're going to get the majority of those returns. And the GP, or the general partner, is again putting together the deal itself, making major decisions, and is going to get a smaller portion of that return, but they're typically putting much less of their own capital in the project as the LPs. They might be putting anywhere between 5 and 20% of their overall capital, but they might be getting back anywhere between 30 and 40% of the overall return from the project. All depends on the economics.
Interesting. Sounds like we've kind of transitioned into deeper waters
Just
in
a little
regards to
bit,
the
yeah.
level of understanding. Let's go ahead and let's jump to that intermediate level of understanding. Obviously, there's a relationship that exists between the limited partner and the general partner. How might these terms, and you've briefly mentioned it, they're more of kind of legal terminology. How might these terms kind of dictate the overall partnership or the agreement between the two parties, seeming that the limited partner appears to be supplying some of the equity capital or just capital in general, whereas the general partner seems to be, they may provide a bit of capital, but it seems like they're sourcing the project, they're operating, they're pulling the value levers, they're making the big decisions. How do these two terms kind of differentiate the role that each of these individuals or groups can play? And then at the end of the question is, what kind of liability maybe do these two positions have in regards to the project?
Yeah. So typically the LPs are going to have much more limited liability than the GPs. And the GPs, they could be taking on, minimal. They could be somewhat indemnified, or they can be taking on a lot of liability or a lot of risk. And the reason for that is because they're going to be compensated for the risk they're going to be taking by their piece of the promote or carried interest, or in other terms, kind of the piece of the deal that will flow to them for doing all of the work. A very standard setup is for there to be a split between the LPs and GPs. Once the LPs get all their money back, there's then a split, call it 70-30 between the LPs and the GP. So if there's $1 million that's invested, the LP contributes $1 million. Once that $1 million has been returned, you sell the property, you sell the business. Here's your $1 million back, limited partner. Any other profits that are left over, we're going to split 70-30, where 70%, so $700,000 in the $1 million total investment example, would flow back to the LPs. But then the GP, who may have put $0 in, receives 30% or $300,000. And it's because they guaranteed the loan, they did the work, they found the deal, they made it happen, and they executed. And that's why the bulk of their compensation is essentially coming from an incentive fee, or it's from the eventual sale and the profits that they receive from the business or the real estate.
So it seems like the terminology in itself of limited partner and general partner, they do have some legal framework, but they also are controlling or maybe a good descriptor of the economics of the deal.
Yeah.
And how the money will essentially flow through the investment lifespan.
Yeah.
Is that correct?
Yeah.
Awesome. What are we missing in that intermediate level of understanding between the relationship of a limited partner and a general partner?
Well, the one thing that can get confusing is that you can be a little bit of both. In some individuals, there's a thing called a co-general partner, and this is known as the kind of the sweet spot in investing for a lot of folks. It's not easy to do. You have to be at the right place at the right time with the right group. That's essentially you are essentially a passive investor, an LP, but you get a slice of that GP. And typically, the way that these are structured is that there's a limited partner investing entity or a holding company that the limited partners are members to, that's where they contribute their capital. And then there's typically a management LLC or a management entity that promote or the carried interest. And that's that 30% of the deal that we were talking about earlier that will flow to the GPs. And so if I'm an LP, limited partner, and I want to invest in your deal. Griffin, you've got a deal. You're coming to me. You want me to invest. I may say, Griffin, I'll write the $1 million check, but I want a small piece of the GP because I want accelerated returns. I like the LP returns look good, but you need me. You need my $1 million because you're having a hard time raising the money.
Okay.
And so you really need my $1 million. For me to contribute that $1 million, I want a slice of your share. And so that's going to give me an outsized return because not only do I get my 70% on what I invested from the LP, I also receive a percentage of your 30%. And so assuming that the equity in the deal is more than just my $1 million, let's say it's $10 million, if you're getting, $300,000 back to the GP, and if I get a third of that, that's another $100,000, rough math, that's going to be coming back to me. And so it's stacking on top of my overall total return.
Trying to find a kind of a pressure point in the general partner, a basic need or a timeline need that you can fill, leverage that in order to boost your economics.
Exactly. And they could be a more, typically you're supposed to have an active role if you are in the GP itself. You're not just supposed to be a passive investor. A lot of LPs kind of get around this by saying they're doing asset management, which is basically you're checking in, you're asking questions to the operator itself. Maybe you're touring the property every once in a while. But not just economics can be shared, but it's also control. And that's where it kind of deviates from the very simple LP-GP relationship. LP is completely passive. GP is fully active. You could be an LP and say you're contributing 51% of the overall equity for the project. You may say, or maybe if it's less than 51%, but just again, Griffin, you need me to get this deal done. I'll say, all right, I will contribute my $1 million, but I want a percentage of your GP entity or your interest. And I also want some major decision controls. So I want to be able to maybe trigger to sell the asset. I might want to be able to, or I want to veto a refi or sale. I want to control any type of capital event. Maybe I want to have a provision in there that if you really screw up the deal, I can kick you out of the deal. Now you're going to push back on that, but
Definitely.
Those are all things that are on the table. And this is all slightly different from a joint venture agreement or a JV, which there's typically is also, but not necessarily an LP-GP relationship.
Interesting. I feel like JVs might be next week's jargon, Ben.
It might be.
So
It's a preview.
The way that I'm understanding this middle ground is a limited partner can find a way to participate on the other side of the fence or the other side of the partnership and the general partner. I think you mentioned previously that the general partner or the GP can allocate their own funds as a limited partner and also play on the other side of the fence as well.
Yeah, I mean, you can structure this two different ways. There's probably more than two different ways. One, a GP, you can, as an individual or through your entity, you can invest either on the LP side or the GP side.
Okay.
And so that's either going to be your dollars are parked at the GP entity, and that GP entity then contributes those funds on your behalf to the LP entity itself. Or you can leave them separated and you have your GP interest, and then I'm going to come around and subscribe to the LP entity as an individual or as an entity to invest. And so you can almost ignore, like I might be a GP, and I'm going to get that promoted interest, and there's going to be some fees associated with it. But I'm also going to make an investment on the LP side. You're accomplishing essentially the same thing, but just through different avenues.
It's very interesting. Like you said earlier, you can muddy the waters, it can get quite complicated. Let's clear the waters before we get into the deep dive tank here.
Yeah.
When we go into the industry veteran at a basic standpoint of those first two layers of understanding, seemingly appears to me that as a limited partner, an LP, you not only would be investing into the real asset or the investment opportunity, but you're also placing a large bet on the general partner to not only do what they say,
Yeah.
but to conduct themselves in a way that is a steward of your capital in order to complete their business, objectives and investment strategies.
Yeah, at the end of the day, I mean, you're investing with the GP. Yeah, maybe you might be investing in a piece of real estate, but all of your trust needs to be on the GP and the sponsor, not necessarily in the piece of the real estate. You want to be trusting that your sponsor and your operator has the skill set and knowledge to invest in the real estate. I mean, maybe you're a real estate expert also, and you just don't have the time. But the reality is, most LPs aren't day in, day out experts. All they do is real estate investment, or all they do is multifamily investment. All they do is property management. That is why you're partnering with an experienced operator on the GP side. And so in the LP, very simply, passive investor, contributing capital, getting the benefits of real estate ownership without really any of the work. The GP, the active investor, they're taking the majority of the risk for the opportunity for an outsized return.
Right. It can be quite simple if you break it down like that. However, you want to get into the both sides of the fence, it gets a little muddy, but maybe that's for a deeper dive later. Let's go to the industry veteran side of this coin. You've mentioned joint venture. You've mentioned the co-GP, and what type of structure that we've used at Great Capital would be a great example to discuss, how muddy these waters can get with.
Oh yeah, we can talk about the Great Fund.
Several different structures where LPs and GPs and co-GPs and JVs.
So Club Meridian is probably the more complicated deal structure. That deal involves a joint venture,
which is JV.
A JV.
Okay.
With Great Capital various Great Capital entities,
okay,
vehicles, and a independent, more institutional private equity firm that's entering into a partnership agreement between Great Capital associated entities and their entities themselves. And the difference between a joint venture, maybe starting just a very simple joint venture, typically is there is a sponsor of the project, similar to like a GP. But the investor on the JV side is almost always investing more than 51% of the overall equity. And so almost always they are going to be requesting, demanding, and requiring full major decision controls. So it's essentially like, look, we're going to be bringing in all the money, or the vast majority of the money. That's our role. Maybe we'll also do asset management. They're going to look at the GP and say, you're going to run the deal for us. Maybe you're going to find it. You're going to operate it. You're going to ensure it's successful. But we're going to have basically complete control over this project, other than day-to-day operations. We'll let you decide what goes on a day-to-day basis. And so it's similar to that co-GP structure of where I'm in an LP. I'm mostly passive, but I've got some major decision rights and controls and some levers. JV is a little bit more of an extreme version of that and a little bit more formalized. So it's not like, I'm just a member of the GP and I have a couple rights. It's a true separation. And the economics are often, not always, a little bit different also. Where on a typical LP GP investment structure, like we've been talking about and Great Capital often does, there's the LP entity, and there's usually, like in our deals, there's a preferred return, which is a rate of return that accrues and is paid out in priority to before other cash flows are paid out to like the GP. And then there's a split, like the 70-30 we talked about. Where on a JV, there's typically a higher initial preferred return that typically gets paid out pro rata or pari passu between, let's say Great Capital's investors and the JV investors. Everyone's going to get paid out a similar preferred return. But then as the property is sold and a positive internal rate of return or IRR can be generated, this is where we start getting into the weeds.
Right.
The splits, there's a series of waterfall splits. So it goes from, basically 12% to 0, 100% of the return goes to both the JV partner and basically the investors. till they've hit a 12% return. Then the cash flow is split, say 60-40 between the JV partner and the LP and the GP itself. And then the split could go to 50-50 after, say, an 18% return. And so it front loads the return to that JV investor, but then incentivizes the sponsor of the project of the joint venture to perform, because potentially if they cross a certain threshold, they can be earning a much higher percentage of that remaining profit.
Right. It's obviously there's different roles to be played. There's different amount of risk to be played in each position, and it's not like you sit down at the table one day and you're just, hey, I'm the GP, I'm the LP. This is a joint venture. This is a co-GP partnership. There's a lot of negotiating. There's a lot of compromising that goes on. It doesn't just happen like that, and it's about finding the right partner in the right asset in the right market at the right time. So I think that when all of that comes together and it works, it can be quite fruitful for everybody.
Yeah.
But there are also times where that negotiation maybe doesn't go as planned, and it can also potentially kill a partnership or kill a deal.
Yeah.
Can you just talk about trying to piece together all of those negotiations and things that otherwise would, make that negotiation go more smooth in regards to how Great Capital operates? I know specifically here in-house, we really do like to hold on to those key decision-making factors when it comes to refinances or capital events.
Yeah. I've been involved in a lot of these negotiations and a lot of these deals in a wide spectrum. I've done deals where, again, it's an LPGP, syndication, relatively typical, and Great Capital. We retain 100% of all the major decisions, control, all that. That's the most deals, to be honest. That's the vast majority of deals that we do at Great Capital. I've also, before we were doing a lot of our own lead sponsored deals at Great Capital, when I was doing a lot of co-GP investing. And you can go back, 8-10 years ago and read some of blog posts that I was putting out about how to co-GP with syndicators. I don't talk about it as much because we don't necessarily want a lot of co-GPs today, because we don't really necessarily need a co-GP for most of our deals. But in some, we still do the bigger deals. And I think it's a great way to leverage someone else's experience before you have as much of experience yourself. So before I started being the lead sponsor at Great Capital and doing our own deals, and we've done almost 10 direct syndications, we have a couple of third parties. I had done 16 co-GP syndications where we were in a GP seat with major decision controls with another operator. And so I've seen this done literally, now dozens of times. And it all started with an initial conversation of, again, needing to raise capital and needing assistance with loan guarantees, because there's a lot of, like, as you mentioned, there's a lot of different roles to put a deal together. You need the capital. You need to originate debt. You have to qualify for the debt. You also have to guarantee the debt. You can be a guarantor of the debt and not qualify for the debt itself. You can be able to guarantee, which is typically it's a net worth and liquidity, component. But then you also need experience, and the lender is going to look at the aggregate of all of the borrowers or all the key principals, which are different. Guarantors also different, and so they can say, well, what is the whole team comprised of? Does someone on the management team or the GP side, do they have property management experience? Okay, they do. Okay, that sounds good. Do they have experience taking out these types of loans, which is a total chicken and the egg problem? And one of the main reasons why I started co-GPing, because I wanted to buy a multifamily deal. The lender was like, I'd love to lend to you, but you don't qualify because I haven't lent to you before. I'm like, well, how do you lend to me for the first time? And he's like, well, just go partner with this guy over here, be a guarantor, and you can start getting this guarantee experience. So then when today, we go to Fannie Mae, we go to Freddie Mac, we go to these private borrowers. I've built out a track record now of guaranteeing loans, so that I have a great history of guaranteeing debt. So, but if you've never guaranteed a loan in your life, at the time I hadn't, but I had some liquidity. And so they were able to use that liquidity to help us secure that loan. So there's a lot of different, needs for that a GP, might require. And so, going through, it's negotiating what you need, how desperately you need it, and then how willing that GP is to give a piece of their own deal away. For our position, it was first just myself. Then I wrapped my family into it. We created a real estate focused family office called Great Properties. I didn't have as much negotiating power at first than when I kind of built the larger team. We built the larger team. We were able to say, hey, we want to put this deal together, and we want this to basically to exist for the next 10 deals. We don't want to just do one deal. We want to enter in a programmatic relationship under these terms. If you show us a deal that we like, we underwrite it, it checks all the boxes. These are the terms under which we would participate, and we don't have to renegotiate this every single deal.
Yeah, that's great.
Like, show us a deal, we like it, we're in, copy, paste, put it all together. We got, X percent of the GP, that we're going to contribute 10 to 15% of the equity, rinse and repeat. And we did 15, 16 deals like that.
That's all. Sounds efficient at that level.
It was, and it was a good time to do it. 2015.
What's the
2019?
What's the main takeaway in this deep tank that we're diving in the LPGP terminology and understanding for our industry veterans?
Never assume that two deals are the same, or two operating agreements are the same. Even you can understand, the definitions as we have defined them today, LP, GP, JV. All that matters is what's in the partnership documents.
Right.
So read your operating agreement. Never assume anything. Read your read the PPM. The PPM should really describe and sometimes go into greater detail describing the operating agreement, the roles and responsibilities. And one question that doesn't get asked that often from LPs is, who holds the major decisions? Who else is in the GP? Are we making decisions by committee, or is there one final decision maker? Or is there one decision maker except for a couple of other really material decisions? And then who is that person?
Right.
What are their incentives? Because they're not always the same as the rest of the LPs or the GP.
They might not be aligned. I think that's a common question that we probably don't hear enough in our LP investor onboarding calls is who else is in the general partner. And in Great Capital, we really do only have specifically one GP in our basic standard deal. If we get into a co-GP, we may have a second party or second entity in that general partnership, but there are syndicators, there are sponsors out there that otherwise have several entities, several individuals in their general partnership that otherwise may have a malalignment with you as a limited partner. So it's always good to investigate who is actually what that general partnership is comprised of and who is again making the decisions, because that can certainly derail or accelerate a deal in the right or wrong direction.
I mean, just think about let's say you got some family office or something that's, a GP with the decisions to trigger a sale, and something goes on in their portfolio and they need a fire sale. They don't care. They just want their cash back.
Right.
It's a 10-year hold, but they don't care. They're in year 2. They're just trying to, raise capital. They decide to take it to market and sell it.
That's a very good point.
To break even.
Yeah.
And that's not what the GP wants, but it's going to ruin their track record. It's not what the LPs want. They took their time to find this deal, but you've got Mr. Family Office investor over here who doesn't care about any of that. They negotiated the rights. Now, how often does that happen? Not very frequently. The amount of times we exercise our major decision controls as a co-GP partner, almost never. But it gave us access to have conversations, and we certainly, have those.
Well, that wraps it up for this week's edition of the Multifamily Jargon Bin. We're going to taper it down in the weeks to come unless it's a good discussion, but we're trying to make this timely. If you're a beginning investor or somebody that's just now discovering multifamily syndication, that first 10 to 15 minutes is really for you. If you'd like to see us tie it all back together, let us know in the comments. But again, if you find that there's value in this section, let us know. And I also noticed, Spencer, as we get deeper and deeper, there's more and more terminology that otherwise those novice or beginning investors would otherwise not know. Highlight those terms for us in the comments, because we'd like to know what to talk about next week and the weeks to come. Yeah,
that's exactly what I was going to say. If you're going to write a comment, please let us know what terms you would like us to break down. Not only just from the the dictionary definition, but our opinion and take on it.
Right.
Yeah.
There's a lot of terminology out there, so it's tough to just pick one a week and then talk about it without bringing in other terms and vocabulary to describe it and discuss its importance in multifamily syndication.
Very true. Griffin, you want to talk about NMHC? You want to jump into this apartment list, state of renting? I think, are fascinating.
Well, let's jump into the state of renting because I think that there may be some points in here that otherwise could be related back to NMHC and what you were
True.
hearing with boots on the ground in Las Vegas.
Yeah. Well, Apartment List, their National Rent Report released their 2026 State of Renting Report. Again, this is key, whether you are an investor or an operator thinking about just kind of where the market is going, what is in the minds of renters today, Gen Alpha, Gen Z, and even some baby boomers. I mean, I think Apartment List has put this survey together to try to help us understand the mindset, psyche of today's renter and what they're also looking for in an apartment in 2026.
This was the first time I have actually stumbled upon the apartment list state of this report, and I think it's interesting because it really does put you in the mindset, of a renter, in today's market. There are several kind of classifying categories that they've included and surveyed, people that are renting apartments or homes and what they're looking for or what they might be putting off because the rent is too dang high.
Well, and you're looking for a rental right now.
I
Also.
currently am, yeah.
So you're looking for a single family rental.
Yeah,
primarily.
Family. Yeah, we would primarily a single family rental, fenced in yard, 2 bedrooms, 2 bath minimum.
Oh man, what everyone's looking for.
If you're out there and you got that on the north side of Indianapolis, shoot me an email. But we're also my wife and I. We have a dog, so it's very important that our dog remains happy. We have an acre piece of land that our dog runs around on all the time, but we're getting ready to undergo a massive home project that otherwise makes us move out. So we have to maintain the dog's happiness. So we're looking at potentially renting an apartment with, what we would desire would be a fenced-in yard, which is a common amenity these days at Great Capital. We will last 3 assets we've bought. We've put in private fenced-in yards on the ground floor for our tenants. So it's
get you guys over to Salon.
Probably would be our number one thing that we're looking for in this survey. But you'll see, there's almost 50% of renters are looking for a pet-friendly apartment, which is something that's really good for us to know. And as we implement our fenced-in yards, maybe we expand that, moving forward.
Do even more of them. Yeah, I think it makes sense. Well, let's just kick this off. What Gen Z and millennial renters are putting on hold? Not surprising. 43% say buying a home. They're putting off buying a home. I wonder how much that is forever putting it off. I'm not interested, or just not right now. But that also kind of underlines the more renters for longer. As much as we saw in politics, the Trump administration coming out saying that we will not be a nation of renters. I don't know how you put the genie back in the bottle, to be honest.
Correct.
That would be something. But 36% they're holding off taking a bucket list trip. Makes sense, especially if you're thinking about buying a home. You're probably not going to be able to buy a home if you take that bucket list trip. Although you don't necessarily have to spend a lot of money. Makes sense. Everyone has a trip that they want to go on, but got to save a little bit of money. 27%. This one, it sounds like an excuse. 27% they're putting off starting a business or a side hustle because that's what they're putting on hold. They're putting that on hold. Why? Does that have to do with the rent?
I have a question for you about buying a home. 43%, 27% starting a business or a side hustle, and this pertains to me. 4 years ago, 5 years ago, I did not understand the power of other people's money or leverage and debt.
Yeah.
Both of those things involve other people's money or at least utilizing some type of leverage. I think we've talked about buying a home on this show several times about, do you use debt to buy a house? Do you not? But starting a business or a side hustle, again, maybe sounds like an excuse. You could go and take out a small business loan in order to get that started.
Depends on what it is. A lot of it's just time.
Right.
A side hustle is essentially just you putting the time in.
Right. A couple hours in the night, especially with all of this new AI, you can really leverage some of that to be more efficient or have it do something for you while you're doing something else. But 27% of renters said they would like to start a side hustle.
And I guess there's a follow-up questions for all of these. It's like, well, why? Is it, why are you putting off starting a business? Is it timing? You just don't have the time?
The assumption of this report is because they're spending
the money?
too much money on rent, which is, I think, the assumption of this article.
Well, that's my assumption. Well, that's what my assumption would be too. But again, it doesn't always have to be. You're saving for retirement. That obviously makes sense. Going to put that off. But also 24% saying having a child. We're going to put off having a child because, assumingly, because the rent is too high. Again, it's not as the bucket list trip. People are focused on the bucket list trip a little bit more than having a child. Some people are making that decision just to have a kid, which is a little bit more expensive than going on a trip.
It is a little bit more expensive. I think and too, just looking at the younger generations, and not saying it's a good or bad thing, but they're very experience based and a little bit more free willed these days. People are having kids at a little bit older age, and they are spending their time and money on concerts and traveling and doing other things that would otherwise be an experience.
It's true, and it's hard to do all that stuff once you're having a kid. Not that you can't do it. I mean, if you have a kid, you might need to start a business to start making the money, but good luck taking that bucket list trip in the first few years at least. Right. Not to discourage you, Griffin, but all right, when breaking up costs too much, 42% have stayed in a relationship longer than planned due to housing costs. That's unfortunate. That probably doesn't do a great trip on mental health for Americans. And that's a large number. 42% are staying in a relationship.
Right.
Now, I wonder, probably a lot of folks stay in a relationship longer than they had planned due to just, having difficulty and having difficult conversations.
Right.
Correct. But certainly when you're like, look, we're roommates essentially, if I move out, I'm going to be responsible for 100% of the rent instead of 50%. I just can't stomach that right now.
Yeah.
That certainly is a factor to a lot of people.
It could be a large burden on some incomes in regards to now having to either front 2 rents or 150% of a rent, or
I just renewed my lease. What am I going to do?
Right.
I have to wait 12 months.
Right.
I would say people you can sublease.
Correct.
If you need to get out, you need to make a decision. You should probably make that decision.
Correct. I think this is interesting because there is a humanistic side to our business, and our site staff does an incredible job of being, humans first and cultivators of community first. And I don't want to say that if you're living at a gray residential property currently, go talk to your, leasing coordinator or your property manager. But have a conversation. There's got to be creative ways upon which, if you are in a relationship or you're sharing a unit with somebody, that otherwise you can work your way out of through just being a human. So it is kind of sad that people are staying in what would be, I would say, undesirable relationships or conditions just because of the rent payments.
Yeah, housing
42%. That's way higher than I would have guessed at the start of the show.
What do you think? Having pets, joint pets before marriage.
I would.
You guys had a joint.
We did, but we got married, and it worked out great. I do know my wife is. She loves our dog more than she loves me, and she always will. And she loves animals so much more than she loves humans. So she would be really sad to know of a couple that split and left a pet behind, or split ways. But I think my wife is typically against pets in apartment complexes anyways. So,
so does that,
so
going back to your own story, does that limit your choices?
It kind of a little bit, yeah. But we want the fenced in yard.
I mean, think about, again, this is why I love having a conversation with folks that are in the market for an apartment.
Yep.
We're talking to folks in our communities that's a real factor. And that's where those fenced in yards, when we look at it and we talk about some of the premiums that we can get for them. Yeah. And it seems a little insane at first, but then when you only have a couple of them, for that one pet owner that does have the ability to afford it, it's a game changer.
So this is, maybe we're getting off track, and we love to do that on the Gray Report podcast, but
we can't just talk about breaking up cost 42%.
She lived in Denver when she first got the dog, and you've been to major metro cities and all of these apartments. Maybe the setback in the community is a little larger, so they have this dead space between the street and the actual physical improvement or structure. Yeah. And so there's nothing to do besides provide patio space. So she had this awesome fenced in front patio where this dog could just be and exist and not in the unit all day every day. And so she's looking for that again. Mm-hmm. And the closest thing that I've been able to find is Solana. At the crossing at 80th and Keystone here in Indianapolis. We just installed fences at Flatston Stones Crossing down in Greenwood. Those look amazing. there's
You guys
no,
don't want to be on the south side though.
we're
That's-
agnostic, but our social circles are not there. So
I was going to say, your world's more on the north side of Indy.
right, there's
Yeah.
nobody else doing sizable fenced in yards. I would say there are fenced patios that would
Yeah.
otherwise, I think, primarily be for just general security purposes of trying to
How
create
many
a barrier.
months can I put you down for at Solana?
Right. Yeah, we're gonna need at least 12.
12?
We got to be 12. This is a large project.
Okay.
Yeah, we want to waive all the application fees.
Okay, you're gonna waive your
Here comes the
application fee.
negotiation.
But no, Brittany can get you set up after this.
Let's do it. Closed.
I mean, perfect. Okay, good. We needed.
Honestly, I think if Brittany talked to my wife, we'd probably each rent our own apartment
I
next door.
will 2 leases.
It's like
that
a-
sounds good.
one of those
No,
hotel
my,
rooms that
my
has the
sister,
door in between.
my sister-in-law, she
Yeah,
lives
Maddie.
there. Yeah. It's I'm over there all the time. It's a good spot.
It is a good spot. When we bought the place, we all were just talking about, wow, I would live here,
Yeah.
and it's just right on
Put
the
your
river.
money where your mouth is.
It's super nice. Yeah, it is
You
great.
have the opportunity to tell all of the investors that we worked with, be like, I am putting my money where my mouth is.
Exactly.
live in
I
Solana.
currently live here. It's not out of the question.
And then they call you like Griffin Howe is Solana. You
Yeah.
can just like wake up, look around, be like, it's
Oh, it's pretty good.
fine.
Yeah.
It's-
My feet are dry. My head's dry.
yeah.
I'm warm. It's negative 2 degrees outside. I'm warm.
Yeah, it's cold. It's cold here. All right, moving on to the next piece. What Gen Z millennial renters actually want? Do you know, Griffin, 44% dream of a suburban home with a big yard? I think you were just talking about that.
Right.
76% value walkability to shops, parks, cafes, and transit. Wouldn't that be nice? And 87% say buying a home is still a major life goal. So even though it's top of mind, everyone's saying they're putting it off,
Yeah.
and almost 90% say at some point in their life, does this indicate that we have not completely given up on home ownership?
It's still a dream. Now, what I've realized in my search for rental housing currently is that if you want walkability and convenience of parks and cafes and transit next door, you're going to pay up for that.
Yeah.
And so if you're 76% of people are really valuing that, but they also want to buy a home, maybe you should sacrifice some walkability and the accessibility to parks, cafes, and transit to have a little bit more affordable
Yeah.
living.
And that makes sense, right? I mean, if the more
Right.
urban you go, it's harder to make that work.
Location,
Certainly you're not gonna get a
location.
yard.
Yeah, right.
It's, no, but it is. Would this say that this now? This is asking Gen Z and millennials, and it'd be interesting if they did if they broke out Gen Z and millennials. If more millennials are a little more interested in that a suburban home with a big yard
Yeah.
now versus the Gen Z are all saying value to walkability to shops, parks, cafes, and transit. But the millennials are like, yeah, I've done that for the last 10 years. I don't want to go. I don't want to go out anymore. I just
Right.
want some space for my dog.
Correct. Yeah.
Or
This
kids.
is so awesome. My wife is a triplet, and so she has 2 sisters, and one of her sisters lives in an urban area in
Yeah.
one of the suburbs here in Indianapolis, and has what I think is like such a great location for walkability and accessibility to be, who she is. And she's like, you guys should move in here. You should move in here. It's not our number one choice. Let's
Yeah.
just put it that way. And one of the reasons it's not our number one choice is just because it's just in the middle of everything, and we don't have that, room for the fencing or the peace and quiet of waking up and being able to sit on the patio and not have, cars and runners and whatever else just flying by. So the more and more I talk about it, the more and more you're going to lease me on a unit on the backside of Solana by the river.
There are that's actually where some of the fenced-in yards are.
There are, yeah.
There are some of those units that are kind of back by the river
Yeah.
that are incredibly
awesome.
quaint,
It's
quiet,
incredible.
really nice.
Yeah.
Except a tour for tomorrow. All right, moving on. What Gen Z millennial renters won't compromise on? They will not compromise. I think this is all very believable. 44% say in-unit laundry. I don't want to go anywhere to do my laundry. It makes sense.
Yep.
Tracks. 43% say pet-friendly policies. You got to let my pet
Yeah.
in your community. Makes sense. Tracks. 43% say central air conditioning. If you got to have air conditioning. Especially if
Right.
you're in a part of the country that gets hot.
It's honestly a
maybe
little
if you're
low. It's kind of surprisingly low.
for the central AC.
Yeah.
Agreed. Only if this is just a geographically diverse question, maybe somebody up north.
Right. You're renting an
Less, like
apartment
if
in
you're in
Vermont.
Maine.
Yeah. Whoa.
Yeah, perhaps. Okay, how far would renters move to save on rent? This is interesting. Basically, 50% would move to a new city.
Yep.
That's a big number. Now only 45 would move to a new state. So move to a new city. Is that like I'm in Manhattan, I'd move over to Jersey City, Indianapolis to Carmel,
Yeah.
Carmel to Indianapolis, or is that like Indianapolis to Fort Wayne? I don't know. But it's pretty similar. 45% would move to an entirely new state. And maybe that's why the Midwest has been getting, again, population growth has been taking up, employment growth has been taking up largely when you talk to people, especially like the more slightly more affluent folks that are like, I keep bringing people that are coming in from like California
Right.
or New York, a lot of California people. And some have a connection with Indiana, some don't. And, it's typically related to a job. But they're like, when I saw what I could afford here,
Right.
they're like, this is a no brainer. And they're buying these like incredible homes because they're like, I basically just sold my home in the valley and I bought it. That was 1,600 square feet. And I bought this 6,000 square foot incredible house.
Quadrupled my square footage for the half the cost.
Yeah. Now, obviously, that's not renters. That's a whole different economic swath. But I think it's kind of a similar mentality.
This question to me is interesting because
Who's moving to a new country?
I'm not entirely certain. And of the 48, 45, and 24% of these people that said yes, then what are you still doing where you currently are?
Yeah,
If you would, then maybe you should.
It's easier to check a box on the internet than to actually get up and move.
Correct. And moving's expensive. And then, you move. There's a lot of components that make me disinterested in moving, social and family and all those things. So maybe there's a reason that would hold them back. But the Midwest is quite attractive if you're looking for affordability. I think we're seeing that.
Yeah. Okay.
This is just a quick summary of the article, but I thought this article was interesting, so I included it in the newsletter this week, just based off of our readership, the people that are reading our newsletter are interested in investing and understanding the trends of what renters are looking for, their owners and operators, and their property management professionals. And so it's interesting to put yourself in the perspective of a renter in the United States and trying to figure out what it is that they're looking for, or what they're in search of.
You have any takeaways? Just kind of putting all that together.
Yeah, I think people are looking for more for less. They want the fenced-in yard. They want to be able to bring their pet. They want to be able to walk to the nice restaurant. They want to have the life that they dream of, but they want to pay a little bit less for it. And I think, don't we all? And I think that the more that we can do as owners and operators to provide these amenities for what is relatively a palatable price, I think we're doing the right thing at Solana, and we're doing the right thing at Flats and Stones Crossing, and really across our entire portfolio. There may be rent bumps involved, down the line, just based off of our business model and the need to kind of outpace inflation for our investors. But we're also providing physical value, to our residents, and they can see it, they can feel it, they can use it. And so I would say, if there's one thing that I can take away, is that we are at Great Capital, at least, we're providing all of these things that renters are in search of, in washer and dryer, yards for their pets, walkability to other things. We're buying apartments in great locations. Flats and Stones Crossing's got two really great restaurants right across the street. There's a third going in right next door. And so we're on the right track. But I think the big takeaway is that people just want more for less. And I think as an owner-operator, if you can provide that and just let them see the value of what you're providing, they may be more likely and more willing to pay the price that you're charging.
Yeah, I always think if you can deliver the value, the rent
Correct.
is much less of a challenging conversation. It's only when just the value doesn't mean meet the price is where you have the issue. And then I agree with everything you said. I think the lifestyle is what people are really talking about. If I had to kind of sum up what you just described, it's lifestyle for less. They want the lifestyle and they want the pets. They want to be able to walk, but they also want it to be somewhat affordable. And I think that's the challenge. I think affordability is relative, and you can't necessarily deliver all of the amenities in the world and the great location, always as cheaply as you would like. And so have a profitable business.
So it's a give and take, and I've just noticed in my search of looking for a place to live, and it's all the single family homes are for rent seem to be a little bit more expensive, just because you have your own space, you potentially have your own back patio, your own yard, and the actual living conditions are way worse. And so as you look at it, as I'm looking at a single family home, it might be in a neighborhood or an area of town that I want to be in, but the actual, bathroom and shower are not exactly what I want to get ready in each and every morning. And then you go and you look at the apartment complex that otherwise maybe is not in this, most perfect location, but the setting and the finishes in the apartment and the amenities, the weight room, the pool, the dog park, all of these things that they provide are kind of packaged into what is honestly, in comparison to a single family rental, has a heck of a lot of value.
Yeah. How have the amenities? Now we're just getting into interviewing Griffin on
Yeah.
your apart or house search, but I think it's very relevant to what we just looked at in the business. How are the amenities, I guess, attracting you? Which amenities are looking interesting and yeah, just curious.
We've beaten the dog space, enough. So that is like number one, must be a thing.
Is dog park specifically fenced in private yard? Dog park also? Yeah, you want it?
We specifically want the fenced in private yard. That's very important to us. Our dog is a great dog, but doesn't do super well around other dogs. And if you ask me, I think apartment dog parks can be quite sad. They kind of sometimes get forgotten and
true.
Overcrowded, and then nobody picks up after their dog. So they're a tough place to always have to take your dog. My wife and I, we pride ourselves in like getting our dog out and about and going walking. And so like if we're going to take our dog out, we're going to go on a long walk. We're not just going to
go on a nice walking trail situation.
So the dog park for us doesn't have any value.
Okay. Well, just that is fascinating.
Yeah.
Because I think there's a lot of people that are the same place as you. I don't see at our communities people taking advantage of dog parks as much as one might think.
I think that's a product of just being in central Indiana, where we do have a lot of city parks and a lot of open and green space to go that is relatively close to all of our apartment complexes or communities. Maybe if you're in downtown New York or in maybe even downtown Indianapolis, where you do have to get out of town to go find a big open space to let your dog run, the dog park could be potentially the best option. Our office has a gym attached, so the weight room facility or the fitness center in an apartment complex is not really important to us, but we have we're looking for that. We have a gym membership in town that my wife uses, but we've got a gym set up in the basement that otherwise we would need to solve for because it does get some use. So there's interest in that, and then just having basically 2 bedrooms, 2 bath would be very important to us, and then. We're looking for a ground floor unit. That's really it. The pool is, not super important to us, but
that's
again,
what I was going to ask about. Do you care about a pool at all?
We just, this kind of puts me in somewhat of a different pool, but we just got, welcomed into a country club in town, and so we have access to that pool, and we're probably more likely to use that. Kristen's sister lives at an apartment complex with a pool, so we have access to pool. So it's not necessarily high on our priority list. If the pool is great, like Solana is, it's definitely going to get used if we live there, but it's not something that we're like have to check that box. And then the reviews are really important.
How has it been navigating the reviews? Because it's you kind of have to. Yeah, it's a lot of navigating that's involved. Because there's some really bad reviews. There's always some that look fake that are good.
I love to find the middle ground review and just read it, because the person that's got the 1 star just had a bad day and is a keyboard warrior. And maybe some of those are real, but many of them are just somebody ranting and trying to release their frustration. And the 5-star reviews are oftentimes maybe padded because maybe there's an incentive along with the 5-star review, or that person like just moved in and has lived there for like 3 days.
Yeah, it was a great move-in experience.
Right.
So ex-releasing consultant was really nice.
Yeah, the 3 and 4-star reviews, I think you can read those and focus on those with an understanding of, hey, people have different pain points, people have different interests, but there's few and far between 3 and 4-star reviews than there are 1 and 5-star reviews. It seems like very polarizing. Hey, this place
I love
stinks,
it or I hate it.
This place stinks or this place is the best.
That is what incentivizes someone to probably write a review.
Correct.
It's like
nobody has an average
experience, and I'm gonna spend time writing about it.
The things that I think should be important, and just because we don't currently live in an apartment, but if you see somebody that's like, hey, we've got so many maintenance requests that are just stacking up, or we've put our sink in, 3 weeks ago and nobody's shown up, that's a kind of a turnoff. And the other one would just be the overall like community-based comments of, hey, we love it. We've made so many friends here, or this place is quiet, or hey, this place is really loud. Things like that that like give you an understanding of what it means to wake up and go to bed there every day.
Yeah.
And to live there and have customer service.
Yeah.
I think are largely important. Now, we haven't read too many of the comments, and a lot of the places that we're looking at would be new deliveries, just because they seem to be having these rent specials and offering concessions, and that's attracted to us. And the amenities are a little bit
what kind of
nicer.
specials are you seeing?
There's a lot of $1,000 off first 2 months rent. We've put no inquiries in just yet. We haven't like put our name in.
Well, I'm going to be asking every week now.
Right.
You know?
Just because I understand the follow-ups that come, and I'm just not ready to take those on.
You should sign up for all of it and see what
Yeah.
follow-ups are.
As a
Well, or
as a Trojan horse.
who is, I mean,
Yeah.
who doesn't do a good job in follow-ups. Now, I know a lot of it is going to be single-family homes. It's
Right.
going to be a different experience, either working with a single-family home property management company,
Yeah.
or maybe some like individual owners, versus
That's an interesting point.
Yeah.
We have found several single-family homes that are for rent that look great, but they're institutionalized, and you can tell because the images all have the watermark across it. Frankly, I'm not interested in dealing with an institutional single-family home.
So do you now, I'm curious, do you know that it's institutional or if it's managed by?
It seems like potentially like it's managed by
because
a
it
larger
could be
group.
somebody
Mom,
like
pop
yourself that doesn't want to deal with it. Or is it invitation homes?
Yeah, the way that I see it, and I have a townhome that I rent, and the way that I see it is, I want to be messaging. I want to be my tenants. I want to be messaging the owner, who otherwise maybe is sending, contractors over to do the work. But I don't want to have to get into a portal to submit a request, to then get an email, to then schedule
you
a call.
want to text the guy like
Right.
my something's broken.
Right. So I put a post out on LinkedIn
Yeah.
a couple weeks ago. It's
Go check out. Have you learned about some of the comments were Zillow?
Oh my goodness!
Have you tried Zillow?
You know what?
Have you heard of it?
I made a pretty passive aggressive comment,
I saw.
and I don't know if that guy could sense it, but his comment was also passive aggressive, I think.
I agree. It was all fine. He
Yeah.
said Zillow. You said thank you.
He also said Craigslist, which is it's a no for me dog on Craigslist on the single family home.
Yeah, but
That's
isn't
just
that where you're going to find? Well, maybe it's Facebook Marketplace now, but isn't that where
That's
you're going
like
to
more
find
mom and
most
pop.
of the mom and pop? Where else are they going?
I also, this is again, we're not in a
You want
rush.
to be sophisticated mom and pop who's figured out how to work Zillow?
Yeah. Yes,
Yeah.
that and or hey Griffin, my uncle's neighbor is renting their house.
Yeah, that's
And
what
we
you
know
want.
them.
Yeah, you want the pocket listing.
Yes.
I got a guy.
Yeah.
We've got a half-finished
Right.
mother-in-law's
You better be
little
careful.
suite.
You
I
better
know,
be
but
careful.
it doesn't have. I mean, we've got a yard, but it's
You
not.
do have a yard. You also have 3 kids.
We have 3 kids, and 2 dogs, and
2
I
dogs.
think the space is less than 1,000 square feet. So I think you would not like it.
So with all this said, we're very early in our search, and I think we have this dreamed up idea of what we're looking for that doesn't exist, and we're just discovering that. I think it'll end up being the case where we do find
What about
ourselves.
an RV? RV on the
So
lot.
this is a conversation for later, but Kristen has been like, just ask Spencer if you can work from home forever, and we'll just get a camper van. And I was like, honey,
Well, you can get a camper van and still come into the office.
Right,
You
just
can get a
park it
camper
right-
van and
fit-
park it right in
fit
the
right
parking
in.
lot. Yeah.
fit right in. She's got a remote job 100%, and
You want to go on a little trip?
I'm so tethered. She's like, Griffin, you're so tethered. I'm like, honey, I have a job. I got to go to work.
Yeah.
Which she understands, but she's if she had it her way, we would go out and buy a camper van from somebody, or rent a camper van, and just start driving.
I always love the opportunity to have a conversation with anyone that's actively in the process of looking for a house, especially apartment, or any kind of rental. Just understand kind of where your head is at, because the business has evolved and it's actively evolving. And as we continue to build out Gray Residential and our centralized operations team, and just meeting prospective renters where they are and how they want to interact with where they want to live in terms of rentals. How can we deliver just a really great seamless experience? What do people want? What do they not want? And we don't get it right every single time, but as we continue to improve and iterate, it's important to really understand just where people are and what they want.
Right.
It's been great.
And it's tough to make everybody happy, but across the portfolio, we've got a place for everybody.
Yeah, 100%. you can't make everybody happy, but I'm gonna go see how many more fenced-in yards we can squeeze in at Solana and Flats.
Right. I think it's a great idea. We teased everybody with your NMHC experience. I know
Yeah.
we're getting a little long. Do you
It's
want to
true.
just answer just a couple questions on NMHC, or should we save that for a later time?
No, it's still kind of fresh. We can still just talk about it, NMHC.
For folks that are listening that don't even know what NMHC stands for.
Yeah. So NMHC is the National Multifamily Housing Council. It's the largest trade organization representing apartment owners in the apartment industry. There is the apartment association as well. But NMHC is like the primary trade org. They also have a direct affiliate PAC that goes and lobbies lawmakers to representing the industry. They put out a lot of great data surveys. And then the annual meeting, which they have several meetings throughout the year, but they have their largest annual meeting once a year at the end of January. In the last several years, it's been in Las Vegas, and it's different from what you might think of as like a conference or trade show where like everyone's kind of doing the same thing. They call it the annual meeting because it is the annual meeting for the organization, but it's really an excuse for where the entire industry gets into all in the same city at the same time. And so I'd say probably 60 to 80% of the activities revolving around NMHC are not official NMHC activities, probably closer to 80+%. It's all of the people who may be attending or associated with NMHC are all having kind of separate little mini meetings or kind of like little mini get-togethers, kind of all surrounding inside and on the periphery of the annual meeting itself. So this year it took place in the Aria Casino, and the entire conference convention space was taken over. There was day of like panels and where I attended going over folks like Jay Parsons and Carl Whitaker talking about economic updates and forecasts and markets and renter demand and development activity and the stuff that we talk about in the Great Report every single week. They also had meetings again for NMHC of what are our governing body, what are we going to do, and here's some young leaders that are up and coming. There's pitch competitions, but then again, that's the minority of activities. The majority are every single broker house in the United States, every lender, attorneys, vendors, but mostly owners, brokers, and lenders are having meetings with all of their clients. So again, like we're not usually meeting with a lot of our local people that we know that we can get together throughout the year, but we still are. And so like we're meeting with like literally every broker contact we have in the industry.
Yeah.
We're having a 20 to hour long meeting with those individuals. What are we looking for this year? What did we do last year? What's our criteria? What's our capacity? And then we're asking brokers, what are you coming out with? What do you have available today? And then for me, the biggest piece of why I like going to NMHC is just the intelligence gathering and just understanding what conversations are taking place and where the market is. And having those conversations, I share that in common with a lot of the attendees. It's like just what's the conversation on the ground? Are people optimistic? Are they bullish? Are they bearish? What are the questions that everyone's asking? Like one big question that was asked and discussed throughout the meeting last week was what happens to all of these 60s and 70s vintage value add deals in C class locations. Previously, there were a lot of investors, just syndicators that were coming in because it seemed cheap, go in, fix them up, add some value and rinse and repeat. There's just no one that really seems interested in that product. And I think the answer is it's pricing. The solution or the cure for some of the high prices for those assets are high prices. They need to come down.
Yeah.
And because my response to a lot of these brokers is, we would buy it,
right,
if we were compensated for the risk. But what I'm not going to do is buy some beat up asset in a horrible part of town that has a very challenging demographic that's going to take a ton of resources to manage and not get a good return. Like that doesn't make any sense. But if we can get double-digit cash-on-cash returns, you can compensate for the the delinquency and the crime, and okay, we'll do it if we're getting paid to take on the risk. But right now, no one's getting compensated for that risk.
Right.
And then that has to do with availability of free money over this last cycle, and just the folks that were focusing on those strategies. A lot of newer syndicators being like, what can I afford to buy? I think I can raise $1 million or $2 million. What can that get me? Well, it's not going to get you an A-class asset, with 200 units, but it might get you a 60 or 100 unit asset that's like, in a war zone.
Right.
Like, all right, well, I'll buy that.
Just in coming to the office every day, I drive, I don't know what it is, 15 miles, down into downtown Indianapolis from the north side. And there's all sorts of multifamily communities that I think are exactly what you're describing. And, they kind of seem lost and forgotten. The owner operator has otherwise, really stopped pouring money into the asset to try to make it a community. And it seems like maybe they're just kind of letting it go. And every time I drive past, I'm like, who's buying that?
Yeah.
Who's buying that? And it seems like it's the same question, but it's really relative to, like you said, the overall risk return profile. And at the very beginning, the price.
Yeah.
And so it seems, just like maybe across the entire industry of just some, price discovery and the understanding of the current owner of the actual value of the asset and its current condition. If you look at like a single family home and they sell it as is and they're not going to make any repairs, it's like what you're buying is a 68 unit kind of rundown, poor location, very challenging operating asset.
And the way it used to be is you could buy that, and if you you could buy it. You could buy it at a point where you could put enough money into it to fix it up that you could attract a slightly better demographic. And the rents had been so depressed because the previous owners had owned it for 20 years and they haven't raised the rents in 15 years. And, so bringing in some money and fixing the units up, you could probably raise the rents without doing anything. But you were buying it at a 7 or 8 cap. So it was cash flowing, call it, 6 to 8% cash on cash, year one. But then you actually put some TLC into it, whether it's cosmetic lipstick or actual, true, renovations. You could start getting some double-digit cash flow. That all of a sudden made sense, and that was compared with the lower risk, maybe core opportunities that might be producing, 5-6% cash on cash return, even call it 4 to 6% cash on cash return. Then that's a real conversation of like risk. It's like, all right, yeah, you're going to go in, buy this brand new, fancy, great looking asset in a great location, and your risk is going to be down here. It's going to be low because your return is going to be commensurate with the risk. Or if you want to go a higher yield play with higher return, higher risk, you can go buy the C-class asset, put some money into it, more moving pieces, more things that could go wrong, but potential for higher return, good cash on cash out of the gate. And then, you can turn that, again, 7-8%, turn it into 12% cash on cash in a couple of years. All right, well, and that's a reason to, wade through the mud in the muck to get in all the pain to get there and deal with all of the headaches that a Class C property may come with, and sometimes not. Sometimes they can be relatively straightforward and relatively easy. But now I'm like, should we get 4 to 6% return on a core plus a core asset, A class, great location, great demographics, or get like marginally more for something that was built in the 70s and it's falling apart?
Right. Why would you buy all that risk when you don't have to?
Yeah.
So what was the consensus at NMHC in regards to some of these C-class assets? Because it seems like every day, every month that I drive by is another boarded window.
So I think the consensus was there needs to be a further like price reset for those assets.
Yeah.
And that's counter to, I think, what people were saying that, the pricing reset has already happened. There's been a 20% kind of correction in apartment valuations, relative to, the peak in 2022. But then the narrative continues that, we're past that and cap rates are starting to maybe recompress a little bit, just maybe rates are coming down. And so we're into recovery mode already. And that is true, I think, with the assets that have been transacting, kind of the 1990s and newer assets. I don't think that's necessarily true with the assets older than 1990.
Yeah.
because those assets there really just isn't the strong bid on. So again, there's some outliers. I mean, like we have some properties that were built in the 80s that, like, a Club Meridian, for example, that, doesn't really look and feel like a property that was built in the 80s. It doesn't feel like it was the 70s. It feels like it could have been built in the 90s. There's the functional and the physical obsolescence isn't there. But if you have a functionally and physically obsolescent asset in a demographically declining submarket and market, you just need to be that buyer needs to be really compensated for buying that,
Right.
and they kind of should be.
And the communication of that to these sellers or would-be sellers or potential sellers of these assets, that has to come from the broker. I mean, they're the ones that is in the market. They understand, if on the buy side, we couldn't go to the owner and just say like, you're totally off base, or that has to come from their their representation and their broker of like, hey, like, look, here's where the market is today. You can continue to operate this asset at this value, but you're going to continue to hold it, and it's going to continue to decline in its physical state, and it's going to become harder and harder and harder to sell at a certain price. So that communication has to come from the broker. Correct?
I think so, and I don't think anyone likes delivering bad news. And what I think is muddying the message is that there are outliers. And like we sold a property just before the end of the year. It was one of those co-GP deals. It wasn't like a great capital like lead sponsored asset. We did this in 2016, and it was a 1970s built asset, C plus and a B submarket, and it absolutely sold at a premium, like knocked it out of the park. And so there's enough like and those are the only deals that are actually transacting, because if someone had offered us 30% less, just never would have traded. Yeah. So the only trades that are in the comps are, they have a reason why they did sell. Like, again, the demographics are good. There is an actual value add story. And so the owners of the unwanted assets and the brokers are saying like, well, there is a comp. They're like, maybe you could sell it. Maybe you could sell it for that.
Yeah.
But the reality is, it's like, well, the difference between you and them is your location really, really, really sucks.
Yeah.
Like, you've had 6 murders
in
the last 3 months.
Yeah. And it's interesting because you, as an owner, you obviously are trying to find the top of the market. As a broker, you're trying to find the top of the market.
Yeah, you don't want to hear those low prices as an owner.
For those assets, it's a different market.
Yeah.
It's a very different end buyer. It's also a very different market. So I don't know. I'd love to see some of the assets that I drive past on the way to work, because I think there's obviously some grand potential. Maybe they're not for sale. Maybe they are.
But part of the whole conversation is that that's where the sweet spot is going to emerge, of finding the assets that aren't necessarily in the worst locations.
Yeah.
But they're being lumped into a category that is just less attractive. And there's a lot of investment criteria that says, 90s or newer. When we were having conversation with brokers, we were careful not to say 90s or newer. We prefer 90s and newer. We really have 2 buckets. We kind of have, call it like, we've kind of have mid 80s to 2014, which is like our value add bucket, and then kind of 2015 to brand new.
Right.
But we wanted to say mid 80s to 2014, not 1990, because if there's a great deal in 1984, 1985, 1986,
still want to see it.
And the low physical and functional obsolescence, prefer to be, 80, 87 or newer. But that's where we might be able to find like the huge deal and the big discount, because there were enough groups that it just didn't get past their screener. And like I've seen deals that were built in 1992 that were much more run down than the 1986 built asset. We have, the property on the east side of Indy, much lower quality than, property up in Michigan that was built in the 80s.
Right.
So there's nuance, but because nuance is ignored by just a lot of people when you're trying to make investment criteria, I think there's going to be a really interesting sweet spot in that. I mean, again, we're not going as probably as old as the 1970s, but I think there's going to be a real sweet spot in that older vintage class of assets.
As you obviously there's takeaways from NMHC and all of its, adjacent events as you prepare to board the plane. And, our entire team basically went out there. We had CEO, CIO, COO, president of property management. I think our vice president of facilities would have gone if we didn't have the big snowstorm. Spending a lot of time and money to travel out to NMHC. How do you prepare for the conference and, sending, obviously our team members out into the conference to try to absorb what they can absorb? Obviously we're looking for takeaways. There's so many people there across the country, just collisions. What do you, how do you prepare yourself to go into these conversations? Are you looking for nuggets of advice? Are you telling people what we're doing? Are you looking for operational leverage? Are you looking for new technologies from vendors to deploy? How do you send gray capital out into NMHC to have the most success?
Yeah, it's a great question. And a lot of it, the beginning of a lot of conversations that we had were, why, what are your objectives?
Why are you going
here?
Yeah.
And we all had slightly different objectives. With like Addison was also, he's our
forgot about him.
Analyst, and so Addison and Jay, our chief investment officer, were meeting with brokers and lenders. Addison manages a lot of broker relationships. Jay kind of manages Addison and also manages a lot of broker relationships. So they did a little dividing and conquering, in all the different markets that we're looking at, but also lenders. There's some meetings that, I'm more involved with, whether it's one of our bigger broker relationships or a larger lender relationship. We met with, Fannie Mae, but Jay and I met with Fannie Mae, with some of our lending partners, while Addison was meeting with some other brokers that we were not super active with, but we still need to meet with them. Katrina was there partially for just like an immersion experience of it's a different side of the business. Traditionally, she's been more focused on kind of the operations, property management, and less on the wheeling and dealing of selling multifamily deals, financing. She's knowledgeable in a lot of that, but just it's seeing the industry from a different perspective. And I'm going to go on her podcast, The Complex, and we're gonna talk about it and I'm curious to talk to her about her perspective, because in her mind, I think she's like it wasn't really a conference like I've ever been to. She was like, it's more of just a crazy meeting of just everyone in the same place at the same time. It's like having a million meetings.
Information exchange.
It is.
Yeah.
But now she was, one of her objectives was to meet with brokers with us, also owners, and some, technology vendors, which it's not a big, there's no trade show. It's not a lot of that, but there's a little bit of that. It's like, while we're there, might as well meet with, some rep that we've been talking to.
Okay.
But, we're also trying to grow our third-party management business as well. And so a lot of what Katrina was out there doing is, in conversations with brokers or owners, is doing a little pitch on Great Res and trying to get that word out there. But then there's other cases where it's, hey, we're going to meet with an equity group or a broker. So much of it is just kind of putting your best foot forward and trying to frame and imprint the image of the company and Great Capital that we want on you, the broker. So when we're going after and pursuing a deal and we're bidding and some other group is bidding, we want you to have just the strongest opinion of Great Capital possible. And so it's like, hey, I've met their CEO, I've met their whole team, I've met the person who does their property management.
Yeah.
And so they don't have to think does Great Capital do their own property management? Like, oh, of course they do. Gray Residential, because I met Katrina. I met their whole team. They were impressive. They spoke well. They seemed like they know what they were doing. They were halfway, their shoes were tied, all that stuff, versus I don't know who those guys are.
Sure.
Because so many times it's been down between us and another group, and we're kind of at the same price and terms. It's plus or minus. And there have been multiple times where we've been awarded a deal, not because we had the best price or terms, but because the broker recommended us over the other group.
Yeah.
Awesome. They're a known quantity. They're an unknown quantity. And we want to be as known as possible. And so we're an easy and safe choice. I know they can raise the money. I know they're going to perform well. I know I not just because I've heard about it, not just because I subscribe to the Gray Report, GrayCapitalLLC.com or on YouTube or wherever, but I've had multiple conversations in person with this team.
Right.
So that's a lot of NMHC is just showing up, being there, having a presence.
You've mentioned just being able to put together a deal. It seems like there's a lot of, talk about acquisitions, things that are on the market. And then also seems like once you buy the property, there's a lot of conversation about operations and maybe even property management going on. You just mentioned equity groups, and seemingly maybe there's some equity groups that attend NMHC. How does NMHC incorporate equity groups, and then how does it differentiate, or how is it different than some of the conferences that you, myself, and Blake are going to that are more allocator based or attended conferences per se?
Yeah, it's a good question. So there's really not, I mean, like, there's definitely like equity groups that are there, but there's not a lot of, in a lot of those equity groups invest as LPs, but there's not a lot of what I would call like your LPs that a lot of us are thinking about.
Okay.
There's not a lot of individuals walking around, or almost no individuals walking around NMHC being like, I'm an investor. I didn't see one of those, and I've never really have. I see groups that are, I am a private equity firm and I have 40 people at my firm and we invest in apartments and we're there.
Got it.
Or, you know, I ran into some family offices that have a staff that are there.
Okay.
I've never run into an individual. Do they exist? Sure, I'm sure they do.
Right.
But that's not the scene typically.
Okay.
There's also not a lot of, I mean, there are some relatively smaller, you know, groups there that are kind of getting started. But but there's much less of that. You know, Gray Capital is on the probably average to maybe even smaller size of the average group that are there. You're talking to groups, and you know they own 10,000, 25,000 units. I mean it's more of the like Avalon Bays or the IRTs that own 100,000 units. Grant Cardone's walking around. You know, his whole team is there, and he's a smaller player also. So, and again, and all of this is like happening like at the conference, but outside of the conference. Like a lot of people don't even have like a badge to get into the conference. It's actually an issue because people are like, do you all have badges? If not, we'll have to meet somewhere else, or we'll have to bring a badge out to you, which they obviously don't like to do.
Right. Interesting.
And so there's like different layers of security also. It's like, you know, to get past certain points, you have to have a certain badge to get like deep inside the meeting where certain meeting rooms are. If not, it's like, oh, we're just going to meet out here in the hallway.
Right.
I mean, some groups are like, we're at a different hotel. You know, we're at the Waldorf Astoria. That's, you know, 100 yards away from the Aria, and we've got a whole floor here. Come to our lounge.
Ah, cool. They'll invite you over.
Yeah.
Interesting. It seems like if you attend NMHC, you can attend the, you know, core purpose of the meeting, listening to the governing body give their updates. You can go to the State of the Union of Multifamily.
Well, that's actually $1,000. That's a whole separate pass,
fee, right?
Yeah, to go to the actual like strategies conference, that's a whole other ticket.
For Gray Capital's purposes, seems like we're just trying to be in and around the activity, you know, generating opportunity collisions to interact with other owner operators, brokers, vendors, lenders. I mean, I have no idea. I mean, you've talked about it enough in the office, and we're talking about it now. The size and scale of NMHC, just a large national conference. In my past career, I went to the national conference, and it's, you know, it's large, but athletic training is a relatively small profession. This is a pretty large industry, but I'm sure, just like you said, you know, there's the mainstays in the industry walking around. When you go to MHC, you know, how many times are people like, oh, Gray Capital, I know who you are, Midwest, known quantities, pretty limited?
Yeah, I mean, I always get stopped a handful of times because the people watch the Gray Report or they get the newsletter.
Seen a webinar.
Yeah, I've seen a webinar. I think that we probably have more visibility than for firms a lot larger than us.
Yeah.
I mean, it's not like we're not that cool to be like a celebrity or anything walking around. But you know, I got stopped a handful of times of like, hey, you know, saw the podcast, and it honestly it usually leads to really, you know, genuine connections and conversations. Met a developer, multifamily that builds a lot around like the Louisville market. You know, they're looking at Indy also. They've done a lot of work. You know, wasn't as familiar with them. Learned a lot about their business. It was really fascinating. Learned some just new brokers that I hadn't met before.
Yeah.
Opportunity. You know, and it's a range of like individuals. Sometimes it's like younger guys, girls starting out, and you know, they're like, hey, I'm listening to the podcast, so I'm trying to learn more, and like, and then it gets into like, you know, career advice, which is, you know, always fun.
Yeah.
But we're not that big of a deal, I'd say. But I do think that having doing the Gray Report every single week certainly helps us. And I get asked all the time, like, is that really worth, doing it?
Sure.
And,
Yeah.
and I tell the details of, we've actually had a lot of people who've invested with us. They've learned about us from the Gray Report. And it's
Right.
not just like an individual investing the minimum either. It's like some folks are actually investing, quite a bit of money into our deals after listening to the Gray Report. Or if you found another way to interact, if you've discovered us, it's a way to like just take a deep dive on how we think, what we think, and you can check us like what our thoughts were, the last
Right. It's
couple of
archived.
years.
Yeah, it is.
It's a little too much. And so that all is good. But then the industry folks, they care about it sometimes more because they want to know what's going on in the industry. And I mean, I think honestly, I think you came up to me, Griffin, before you worked here.
Yeah.
At what's a place, the restaurant that's no longer there?
Blue Point.
Blue Point.
Yeah, it's a good spot.
And you were like, I've been listening to the podcast.
I had, yeah.
Yeah.
It's good. It's a.
You were breaking into, you were getting back into town. You're breaking into real estate, figuring out some next steps.
Yeah, that was a long time ago.
You were
But
one of
also
those
it wasn't
people.
that long ago. It feels like a long time ago.
does.
We have calls all the time where people are like, I feel like I know you guys because
Yeah.
I watch the podcast. Like I feel like I understand the way Spencer's brain views the market. I feel like I understand the way he's looking at investment opportunities. This is time well spent, no doubt about it. And then when you go to events, you have a recognizable, some facial recognition, and those people that have the courage to come up and say hello. That's awesome.
Yeah.
It goes a long way.
Well, I also think it filters people out because they're like, all right, I want to work with these guys, or like, hey, I definitely don't want to work with these guys.
Yeah. No, it's a very good, what do they call that? Colander. I made spaghetti last night. Sorry. Yeah, it's colander.
Filter, colander. Yeah.
This is the last question about NMHC. It's possible that you leave there with nothing, but what is one thing that you left NMHC with that across 2026 we at Gray Capital or Gray Residential will implement or will consider and when this year ahead?
Well, I guess some of that was, I think, that we're already in motion maybe before we went to NMHC. I think that there's some technology decisions that I think I'm further along with making. Probably not making the decision, or we're not going to probably implement everything immediately because there's a lot of change management to think about. But as we continue to build our systems and infrastructure, just trying to really making sure we're using the right foundation to build on top of. And so it's a lot of conversations of how open your APIs are, what we can connect with, everything. We have been on Google as before in terms of Google Drive, Gmail, all that. We may have switched to Microsoft. Maybe thinking about switching back to Google.
Yikes.
Which is horrible to think about, but we're just in a very different world when we made that decision.
Right. Totally different world.
And I mean, just an example as we're wrestling with that choice, haven't made the choice, Microsoft or whoever needs to know or not know. We've noticed using ChatGPT connected to a lot of our data. It's all closed and everything, but so we've got the enterprise version. We have both SharePoint, which is Microsoft, and then our old Google Drive, which is all archived information from a couple years ago.
Yeah.
It really only wants to look in the Google Drive, and we finally ask why. And it's so much easier for it to access all the files in the way that it just organizes the folder hierarchy.
Interesting.
And indexes it. It's a path. It follows a path of least resistance.
Yeah.
And so it has a hard time. And again, I'm not technical enough to tell you exactly why, and the difference between how Microsoft indexes its files and how Google Drive does it. But again, it's as we're adding in new layers, we want to be using a system that is very much adaptable. And again, I mean, just the leapfrog that we don't want to be too trendy and shift back and forth. But the leap that Google made with Gemini recently, and then compare that to how not really useful Microsoft Copilot is. It's just making us making some big decisions that we want to take really seriously and are not going to make lightly. Even decisions on our property management, software.
Yeah.
We're big RealPage users, and there's a lot of things we love about RealPage, and so we just have questions on the future of Real Pages openness with their APIs. If they'll even have open APIs, it's a beautiful walled garden in many ways.
Yeah.
But there are these amazing tools that are out there that we want to be able to incorporate in a variety of different ways, and we want a system that we can choose the best of whatever is out there, not just the best of whatever RealPage or Microsoft is able to buy or produce internally.
Right. Understood. You said it.
That's not anything to do with multifamily, but that's just my honest.
It impacts the daily work environment here at the corporate office, and it will do the same thing across all the sites.
Don't mention anything about the Google, Microsoft, anybody.
I won't.
No one's gonna. No one in the office is gonna listen.
Nobody will. Blake's gonna throw a fit.
He's gonna like it though.
He will like it.
He's gonna roll his eyes.
You said in the office the other day, there's a lot of things that we are, ahead of trend or right on trend with, and this is coming back from NMHC in regards to just corporate work environment, property management, operations and ownership of assets, investor relations, investment management software. But there's also some things that we are maybe behind trend on, and I'm just excited to see a year from now when you return from NMHC in 2027, how we've done in maintaining, at or above trend in some of these, movements, whether it's across your tech stack, across operations, across investment management software. It'll just be interesting to see at what trajectory and what pace we can kind of continue to operate. I know you like to keep the jet fuel on hand, so we're going to see if we can keep the pace up.
Always need some jet fuel.
Always
on the fire, especially if it's good.
Yeah. Oh my goodness, that's a way to do it.
Yeah. No, it will be interesting. We're going to be in a things are going to look different in a good way. They were kind of due in many ways, but again, I don't think what we are doing, what we've done is anything like revolutionary, but it's the stuff that needs to be done. And really it's just like standard stuff in other industries. It just is not as prevalent in property management.
Right.
But again, trying to, so much of the conversation is about, like reducing costs, and there's like definitely opportunities to reduce costs. But I hate the private equity model of like reducing value. You're reducing the cost, but like you're also losing a lot of value. And I think that there's a lot of options to be able to deliver better value for the same cost, or even a little bit less. And a lot of that's technology. Some of that's with training, having some specialization. I think in property management, especially, we have a lot of like generalist positions, like property manager, maintenance supervisor, and not a lot of like expertise. So trying to bring in some more like experts to do more. So we don't have a lot of like jack of all trades doing nothing that well. We have some real experts having specific silos that do it exceptionally well, that we can deploy across the portfolio. And so everyone can focus on individual tasks rather than like I'm kind of like everything falls on me.
Right. Spreading themselves thin and across several components.
Yeah. So that's how you lose people, and people get, just worn down, and it's a lot of work. And
makes sense.
We don't have all the answers, but we are passionate about the pursuit.
Right. So if people want to, dive deeper into your takeaways and your experience, and really Katrina Green's experience, Director of Property Management, President of Property Management at Gray Residential, and her experience at NMHC, they can listen to the Complex podcast, which you guys will be recording later this week.
I have to talk to Katrina. I believe so. Well, and I think she's gonna, in general, I think it's gonna be coming out every other week consistently. It's been a little less frequent getting a cadence down, and I know one of Katrina's goals for this year is to bring some consistency to the Complex, which I think is just an excellent pairing to the Gray Report. Again, it's more operationally focused, it's more property management focused, it's about the people, the systems. And so again, if you're it's more for people in the industry. I would say if you are an investor and you really want to understand the actual business that you're investing in, not just the financing, but the business, it's a great podcast to listen to. And there's not that many that really cover the topic. Yeah. So it's pretty unique.
She's done a great job of welcoming on guests as well. Different perspectives from different aspects of the property management industry. Speaking of guests, we don't need to name names, but for the folks that are here with us this deep in the podcast, I definitely think we should tease Gray
Yeah,
Gray Report podcast.
yeah,
Special guest coming up.
it's not confirmed. We got to confirm it. But I had a great conversation with Carl Whitaker of Real Page. They're I believe chief economist. And yeah, so we haven't confirmed yet, but it would be he's coming into Indianapolis, and we're excited to potentially host him here in the studio. Again, Carl's a friend of the show. He's been on the Gray Report 2 or 3 times in the past, and just a wealth of knowledge, smart guy. We've got a decent amount in common outside of multifamily, which was fun to talk about. Yeah, he's going to be here live in person again. Date TBD and final confirmation is coming. But yeah, it's a little bit of a
I think that's exciting. Something that we're trying to do more of in this year at the Gray Report podcast is welcome outside perspectives and voices.
100%.
Special guest, friends of the program,
friends of the pod.
Yeah,
exactly. All right. Well, this has been a great episode. Thanks for sticking it with us. Make sure you subscribe to the Gray Capital YouTube channel, like this video, and share it with all your friends. We love LinkedIn. Just share to LinkedIn, copy the link, and say, check out the Gray Report.
Yeah.
All right. See you next week, everybody.